in the second last year, your GDP is 1.6 trillion, your change in debt is 400 billion, the total is just over 2 trillion. The year after, GDP has gone up by 10%, but the change in debt is much smaller because it's stabilised. It's gone from 10% increase to a 20% increase to a 10% increase. It's gone from 415 billion of credit to 250 billion of credit, and the aggregate level of demand is actually lower than the year before. So even at that level, you get a slowdown in demand. That would be recorded as a recession. Now let's look at the actual levels of debt we're looking at these days in places like Australia and China. What happens if you have a starting point of 125% of GDP as your debt level, and that rises at the same rate? Well, you reach 193%, which, by the way, is about 15% lower than Australia's current private debt level. What you get in the final year is the GDP is still at 1.6 trillion. The change in debt virtually half a billion. Total demand 2.12. The year after, 10% higher GDP, much smaller credit growth, and you actually have a negative. The aggregate is less than it was the year before, and you have a recession. That's what I was expecting to have happen to Australia back in 2007, 2008, but the Rudd government's policies stimulated private borrowing once more, what I call the first-home vendors boost. Got the household sector back into borrowing again, and then, of course, you had all the borrowing coming after that from the business sector for the minerals boom, and now we're getting to the end of both of those, of course. So a debt crisis is inevitable for countries which have a high private debt to GDP ratio, because to sustain the growth rate they've got requires debt to grow faster than GDP forever. It simply can't do that. And we are now, in Australia's case, we now have the highest level of household debt to GDP in the world. That's out of the 41 countries we have data from the BIS. So a crisis will occur even if GDP continues to grow, which of course it won't. And this is why all the countries you saw having the global financial crisis did so, none of which, you'll see none of this argument with the mainstream, by the way. They still are simply ignoring the role of debt even 10 years after the crisis occurred. So let's look at Japan, which was the real, that should have been the canary in the capitalist coal mine to tell us something was fundamentally wrong. If we'd learned from Japan, I wouldn't be having this conversation with you. Now, the line that everybody focuses upon here is the orange line, which is the ratio of government debt to GDP. And you can see that was quite low, about 60%, and trending down before the financial crisis hit, and then it's been trending up ever since, and that's what all the commentary in the media and in mainstream economics is about. What really caused the crisis was this huge explosion in private debt, particularly the last 10 years, which the Japanese themselves referred to as the bubble economy period. Then that level stabilising and now falling. That stagnant and high level of private debt is why Japan has been in the funk for 1/4 of a century. And it's something we simply can't afford to repeat in the far less homogenous societies we have than Japan has. So when you now look at the change in debt, can I identify when the crisis began? The red line is change in private debt. The crisis began in 1990. And when you correlate credit with unemployment, again, according to the mainstream, there should be no correlation. That's Ben Bernanke. You can look at page 24 of his essays on the Great Depression. There should be no significant relationship between debt and macroeconomic variables. That's correlation there over 40-something years of data is minus 0.88. I think that's significantly different from zero. Any disagreement? They continue ignoring this stuff. I've been publishing data like this for 10 years, and I still don't see any of them do any empirical research on it. Now, when you then look at the asset markets, of course, there was a huge bubble in household debt going from 3% of GDP to 9% of GDP, and then you can see the plunge that occurred there. Up goes the house price index until shortly after the peak of the private debt borrowing, and then it's fallen 70%, and then it's flatlined ever since for about the last 6 or 7 years, flatlining with that huge fall in house prices. Now, what drives, and this is a slightly complicated argument, what drives house prices is the acceleration of mortgage debt. And I'm now going to define mortgage debt. The change in mortgage debt is mortgage credit. So when you think about the monetary demand for housing, it's fundamentally mortgage credit. You divide that by the price level, you've got a rough index of how many physical houses can be bought. You take the physical supply on the other side, you do a simple analysis of a price equilibrating between the two, and you find there's a relationship between the change in mortgage credit and the change in house prices. This is the Japanese data. that correlation over, what we got there, 55 years is 0.5. Now again, this is supposed to be 0 according to the mainstream. And the economy, I call this little graph my smoking gun of credit, because what I do here is take GDP as the red line, add change in debt to it, which I know is empirically slightly wrong, but it's a reasonably accurate guide at the same time, with so much debt being created for asset purchases these days rather than goods and services. And the Japanese economy tanked when the credit level started to fall. Credit I'm graphing on the right-hand side here. This level of credit, which is change in private debt per year, is 27% of GDP. That was the peak level. It then plunged down to minus 15% in 2000, and for most of that period it's been negative. When you add the two together, GDP plus credit, you see that they haven't had the same level of nominal demand in Japan ever since the crisis. Now, before the crisis, the average level of credit for that decade, 1980 to 1990, was 15% of GDP. The average since then has been minus 0.5% of GDP. So what we're facing in Japan's case and also in America is not secular stagnation. That's a piece of jargon that Larry Summers has dragged out of the past and tried to explain what they can't explain. It's credit stagnation. Credit demand is a normal part of a well-functioning capitalist economy, but it's evaporated in all the countries that had these debt bubbles. We're one of the last ones to still be having credit demand, which is about to run out. So look at the United States now, using the same scale on the left-hand side. So America didn't reach the same peak level of private debt as Japan did, but same story. Government debt was falling with a couple of blips, courtesy of invading other parts of the world and bombing the hell out of them. But the rise in government debt began after the crisis hit. The crisis was caused by this level of debt peaking and then falling. Now looking at the change in debt, which again is credit, and graphing that against the unemployment rate, the correlation of credit to the unemployment level in America over 40 years, pretty much, 35 years, is minus 0.64, and you take the years from 1990, it's minus 0.93. So credit is the fundamentally dominant driver of economic activity in America. And again, looking at that house price story, you have a dramatic increase in house credit, mortgage credit, going from 3% of GDP at the bottom of the end of the 1990s recession up to about 10% of GDP, then plunging, then starting to rise again, and house prices have recovered a bit because they have risen. Look at that relationship of the change in mortgage credit to the change in house prices, and using Granger causality, which is a very inappropriate way to measure this causality. It's more likely to reject causality when it actually occurs, because like most econometric tests, the Granger causality is completely linear in its logic. This is a highly non-linear relationship. But the correlation between change in house prices in America and change in mortgage credit is 0.6 since 1976. It's higher again, of course, since 1990, after the bubble really took off. So what's driving house prices is accelerating mortgage debt everywhere else in the world except Australia, because we're different, aren't we? Well, we'll see that in a moment. Here's the smoking gun of credit for China, for America. And again, I'm graphing on the same scale on the left-hand side. The peak up here is 60% of GDP. Hong Kong actually got that high in 1 year. But America's peak level of credit was 15% of GDP when the crisis began, plunged to -5. It's now back about +7. But if you look at the aggregate over that time period, it simply hasn't had the scale of credit demand any more than it had before the crisis. Now, Australia, we're different. Let's see how different we are. Again, we all listen to Malcolm Turnbull, and for that matter Bill Shorten, on the TV. Of course, we know that this little figure down here is really scarily high. Got to do something about it. Let's hold a plebiscite, maybe. But of course, this level of private debt up here, well, you can go surfing on that one. Nothing to worry about there at all. Looking at the correlation of credit to the unemployment rate in Australia, -0.6. The same scale we're talking about for America. Looking at the house price story, of course we've had nothing but a bubble, and of course we know house prices always rise, particularly around Mount Kosciuszko. That's plunged to some extent after the GFC, but it's still substantially positive. Again, courtesy of government policy dragging people back into the housing market. What about the correlation? Does the same causal relationship apply? Of course it does not. Oh dear, but the correlation is exactly the same as in America. Accelerating mortgage debt drives change in house prices, even in Australia, even with all the government intervention, even with all the foreign buying we're talking about. It's still the same basic causal mechanism. And then take a look at credit now. This is the smoking gun of credit for Australia, and of course it hasn't shot us yet. Notice that the one time it plunged and went negative is back in what we call Keating's crisis, okay? The Keating recession. That's the one time we've had credit growth being negative, or credit being negative. But then we hit the peak in the GFC of 25%, 10% higher than the Americans. But rather than hitting negative down here, it turned around because first of all, what I call the first-home vendors boost, dragging first-home owners back into taking on debt once more. And then after that started to peter out, which was back in 2010, the business sector was borrowing up big for the mining boom, which the RBA assured them would last 30 years. They're only wrong by, 25? Pretty close for the RBA. Now, what's happening now is we're finally seeing a fall in that level of credit. So I'm breaking it down here. The red line is total credit, which peaked at 24% of GDP at the global financial crisis, went negative for the business sector. And this also happened back in the 1990s recession and at 2002. So business credit is much more volatile than household. But the household credit was positive enough to make the aggregate remain positive. So without the boost from the housing sector through the first-home vendors boost, we would have potentially had a recession back then. The thing that stopped us was dragging the household sector back into debt once more. And on this whole front, I've got to take a slash at the bunch of so-called experts up the road. The RBA, I think, if I had to give an award for the most out-of-touch central bank on the planet, it would be them. The Bank of England has woken up quite substantially to the nature of the monetary system, and you get a very intelligent conversation with the Bank of England, and they're amenable to talking to characters like me. I have been once to the RBA. That was on my invitation of me to take a consultant there. I've spoken with RBA staff a few times, of course, but I actually wrote to them in 1996, I think, offering to run a seminar on my Minsky model, and got a letter back, I think, from Glenn Stevens, I've lost the physical letter, declining my offer. Monday of this week, I received 2 invitations to seminars by the Bank of England to present. The Bank of England is far more open-minded and far more realistic about the monetary system than the RBA is. And if you look at what they've done, they were the very last central bank to stop raising rates after the global financial crisis hit. So far as they're concerned, they were fighting inflation. Classic instance of generals winning the last war. America, on the other hand, plunged right down to zero and stayed there. When they thought the financial crisis was over, they started raising rates again to fight inflation, which made the mistake of not occurring. So they're cutting rates and they're slowly resisting the pressure, but they're being dragged down by reality back towards the zero level that applies in the rest of the world. And the inflation bogeyman, they thought there was a bit of a rise in inflation immediately after the financial crisis here, but it simply hasn't come back to anything like the levels they thought it would. They're being dragged down by the inflation rate being lower than they always expected it would be. And they're certainly their forecasts are probably the least accurate of any central bank on the planet, and they've all been inaccurate. What they've really done is give us the highest real interest rates in the OECD since the crisis hit. So the blue line is American real interest rates, which peaked at 4% not long before the crisis hit, but after the crisis went as low as minus 3.5%. Now, Australia's case, they've always been positive except for a short while between 2014 and 2015, and they are the highest real rates of interest on the planet, outside countries like Venezuela. What it actually has done, what they've all really done, is drive up the exchange rate and decimate Australian manufacturing. Because when you had rates that much higher than applied in the rest of the world, then you made a carry trade an absolute no-brainer. You got the bonus both of appreciating currency by dragging in the dollars, and you got a higher rate of return than you get in the rest of the world as well. Now that that they're dropping the interest rate, the currency is also falling. So that particular trade's being killed. But they've killed manufacturing in the process.